morning. It's the beginning of another business week, and it's best to start it off here on Channels Television with Business Morning. I'm Ini John Mekwa. Well, one of the current conversations in the business space in Nigeria is the inflation figure with the National Bureau of Statistics released on Friday, the 15th of August. The data shows that Nigeria's headline inflation rate has dropped for the 7th consecutive month to 16.63% in September. The latest decline is 0.38% lower year-on-year than the 17.01% inflation rate recorded in August. However, the NBS report shows that core inflation rose by 0.33% to 13.74% last month. The closely watched food inflation index dropped to 19.57%. Urban inflation rate fell to 17.19%, while rural inflation rate dropped to 16.08% last month. Meanwhile, the Statistician General of the NBS, Simon Harrier, said that decline in inflation rate is an indication of a positive trend and recovery of the economy, considering the current difficult economic situation in the country. Well, of course, we expect reactions to come from this. Economists have been chewing on this data. One of them is Dr. Muda Yusuf, former Director General of Lagos Chamber of Commerce and Industry, and now the CEO of Center for Promotion of Private Enterprise. Dr. Yusuf believes that inflationary pressures remain a key concern in the Nigerian economy, both for businesses and for the citizens in general. He joins us now to share what he sees as the implication of this drop in inflation, even though core inflation is still increasing. Good morning, Dr. Yusuf. Good to have you on the show.
Good morning. Great to be with you.
Sure. So what do you see as the implication of this? I think it's like a two-way thing. Food inflation is down, headline inflation is down, but core inflation is up. What's the implication of this?
Well, first, we must commend the fact that we have seen a consistent deceleration in inflation rate over the past couple of months. I think that is commendable. But the reality is that inflation at over 16% is still very, very high. So we need to worry about the implications. First, because of the intensity of the inflation level, operation costs and production costs remains very high. There are effects also on the sales. There are effects on turnover. There are impacts on the profit margins of businesses because of the inflationary pressure. There are also implications even for the welfare of the people, because if you talk to any Nigerian now, especially the average Nigerian, the major conversation now, or the major concern as we speak, is about high level of prices, high food prices, and inflation pressures generally. So there's still a very serious welfare effect around the inflation. So both from the citizen's point of view and from business point of view, we have been seeing very significant concerns around inflationary pressure. So that is not to take away the point that we are beginning to see a slight drop in inflation. But again, there's still a whole lot that needs to be done around inflation, because the capacity of investors to pay jobs, the capacity to expand, the capacity to grow, all of these things depend on how much progress businesses can make. But in the current inflationary environment, even though we are seeing some marginal declines, inflation still presents a major challenge, both to businesses and to the citizens as well.
But the figures show that food inflation has tapered, and yet, like you rightly noted, I mean, we all go to the market, we all buy things in the open market, in supermarkets, and we see that prices are, however, not tapering. So how do we relate these two?
Well, of course, there are issues. I mean, there have been discussions around that. There are issues of seasonality, for instance. But more importantly is to look at the factors that are impacting on this, which is the issue of security. Even though we are supposed to be in a harvest season and inflation is supposed to be dropping more significantly, because of the security situation around the country, which has been affecting particularly those who are in the agricultural sector, food production has gone down dramatically. And irrespective of what you say, once there's a drop in output, prices are likely to rise. So the security factor, I think, remains a major factor in all of this. And across all segments of products, the monetary factor is also important because we don't talk so much about issues of the monetary dimension to inflation. I'm talking about monetization of fiscal deficit, which has very serious implications for liquidity in the economy. As at the last count, we understand that the CBN overdrafts to the government has accumulated to about 10 trillion. This has very significant implications for liquidity. It has very significant implications for inflation. I think the monetary aspect also is something that we need to deal with, to compare the CBN, at least to limit the monetization of fiscal deficit to the statutory threshold that is stipulated, of course, in the CBN Act. And of course, we have the structural issues, which is affecting the entire agricultural value chain. When I talk about these structural issues, I'm talking about issues of the processing, the production, the transportation, and all of that. All of those things also have very significant impact on food prices. That is why most times you see a very huge differential between what you call the farm gate price and the market price. It's because of the challenges of having to move these products from the farm to the market. There are issues of also the perishability of some of these items, the handling of the items, the cost of transportation. Now the cost of diesel has gone very high. Many of these vehicles that move the food products, most of them are running on diesel. So all of these things have a way of impacting on inflation and the final prices that the end users pay.
All right, Dr. Muda Yusuf, thank you so much for sharing your thoughts with us. Enjoy the rest of your day.
Thank you very much, my friend.
So we'll take a short break now. When we come back, we'll continue the conversation around the September inflation figure. Join us again. You're welcome back. Well, I was talking about the inflation figure. Now we have Damilola Lupo, financial sector analyst with Chapel Hill Denham, to give us his own perspective. Hello, Damilola. Good morning. I think your microphone is muted. Could you unmute yourself? We can't hear you.
Is it better now?
Yes, now we can hear you. So I'll just go straight and ask, were you expecting inflation figures to taper? I know FDC had said it would go up, but now, of course, we saw it coming down. Did you see this coming?
Yes, we did. We had highlighted that the headline inflation for the month of September was going to decline, although it declined faster than our expectation. And what we had said was the base effect, we started at the earlier part of the year, was still going to drive inflation numbers, headline inflation numbers down. And true to our expectation, we saw headline inflation, declined 38 basis points to 16.63%, which, like I said before, is broadly in line with our expectations. And, driving the inflation was the decline, we saw in food inflation, because over the month of September, core inflation rose. So to your question, we had expected the dissipating headline inflations, and it didn't come as a surprise to us.
So food inflation drove the headline inflation, but Nigerians get a bit confused, about this issue with the food inflation, and yet prices are not decreasing. How do you relate to this too?
Yeah, okay. I agree with you. The general food prices, in the market, are a bit elevated at the moment, especially when you compare it to pre-pandemic levels. But the inflation basket, measures the prices of food products, farm produce, and major food items. And what we saw was in the month of September, food inflation, moderated, from the 20% levels, we've seen over the past few months, particularly since the COVID-19 pandemic began. Food inflation, was 19.57%. And whilst it appears that we haven't seen, that filter into lower prices of major food items. I want to highlight that the underlying driver of some of the food items, we find, on the shelves, are majorly coming from the imported food inflation, as we understand that most of these items are imported. And, the major driver of the decline in headline food inflation, we saw in the month of September was also largely due to the harvest, we had in September. But I will also want to point out that on an average level, if you compare the harvest, we have in September to the pre-pandemic levels of 2018 and 2019, the harvest season is still somewhat weaker than what we had before, as the major food producing states like Borno, Yobe, and the northwestern states, are still facing various security concerns. So we are not seeing moderation in food prices like we would have seen if the pressures in those regions are not there. So I agree with you that on the street, the prices of food items might not be reflective of the decline in food inflation we've seen. But I also want to point out that if this trend, continues in the coming months, then we can start to see this decline in prices, filter into major basic food items.
So some analysts have suggested that perhaps there is a need to restructure the commodities basket that is being used to measure inflation, so that, for instance, this food inflation, whatever figure comes from the NBS will reflect the reality. Do you think along this line?
Yes, I do. I also think along this line as well. And this discussion has been around, for a very long time. I would say maybe over the last 2 years. I think it's just a matter of time. The Nigerian Bureau of Statistics, I believe, would revisit the major constituents, of the inflation basket, and which might give birth to the food inflation, having less influence on the overall headline inflation. Currently, the food inflation basket, currently accounts for bulk of the headline inflation. And we currently understand that, major items or major prices of other items, we use on a daily basis, especially the non-food items, are not adequately catered for in the current inflation basket. So I believe that, a major catalyst for the decline in food inflation might be the restructuring of the inflation basket. But we don't have a specific date as to when that will happen. So I think for now, we are just left to activities around, the harvest season and other factors, affecting the food prices and other core components as the underlying driver for the decline in headline inflation we might see in the coming months.
So if that thought was to be followed through, that is restructuring the commodities basket, what changes do you think should be made to make it, to make the figures real?
Okay. I think first of all, a major constituent of the inflation basket, is the food, like I mentioned. And when you also look at the food basket as well, it's made up of farm produce, majorly. And you would agree with me that beyond the farm produce, there are other essential food items, that filter into inflation numbers, and their weight currently in the inflation basket, is not so much, and we might not see the kind of impact, we are expecting to see. A typical example is, that Nigeria is a major importing country, and most of our food items are imported. But it will surprise you, to find out that the imported food inflation, is still a fraction of the inflation basket, and bulk of it is still driven by prices of major farm produce. So a major change I would like to see is, the current prices of farm produce, have lesser influence, than it does at the moment on the overall headline inflation. And we should now start to see, prices of major items, stationaries and other items, we use on a daily basis, filter into the computation of headline inflation.
All right, just very briefly now, there's been a lot of effort by the CBN by lending to the agricultural sector. Is that having the expected or desired effect?
Over the past year, it has not had the expected effect. I think the CBN has disbursed about 791 billion to about 3 million farmers, under the Anchor Borrower scheme. And you would expect that with that particular amount, you will expect to see food prices, decline faster. But then you would also agree with me that the COVID-19 pandemic as well has also disrupted activities of farmers, and that has made the decline in food prices. That has made it slower than it is. So as the economy returns to normalization, we'll begin to see, the impact of CBN's lending to the agri sector, filter into the inflation numbers, going forward.
All right, thank you so much, Damilola Lupo, financial sector analyst with Chapel Hill. Then enjoy the rest of your day.
You too. Thank you.
So after the break, Nigeria is one of 4 countries to resist the global minimum tax agreement. Let's find out why. It's Business Morning on Channels Television. You're welcome back. 136 countries have agreed to set a global minimum corporate tax. The goal of this is to eliminate tax havens and make it much more difficult for companies to take advantage of another country's lower taxes. The way to work is that any company, wherever based, anywhere, pays at least 15% in every country that it operates in. Interestingly, Nigeria did not join in this agreement. Well, to tell us the backstory and maybe why and some of the things that Nigeria may or may not be losing, we have Senior Manager at Anderson, Temitope Kolade, joining us now. Good morning, Temitope. Good morning. Thank you so much for joining us.
Good morning. Thanks for having me.
So first of all, help us to understand how this will work. We know it's a minimum of 15% tax for multinationals. How exactly is it going to work?
Okay, thank you again for having me. Let me say first that it's not just about the 15% global minimum tax. There are 2-pillar approach. Actually, the OECD started this work sometimes in September 2013 to come up with a 15-point action plan to deal with the base erosion and profit shifting activities of multinationals. And then it came down to 2-pillar approach. The first pillar was basically to ensure that, number one, there will be a reallocation of profits by multinationals, because typically what has happened is that we have a digital economy, and without even having the brick and mortars, you can continue to derive profits from jurisdictions that you do not have physical presence. So with the digital economy, the idea was to then say, okay, you have earned as much as this profit in this place. Part of that profit will then be allocated to the market economy, to the market jurisdiction, and leave the others for the home countries to deal with. That's the first pillar. The second pillar was then the global minimum tax, to ensure that the profit that is also being earned is not pushed to low tax jurisdictions, such that it then also reflects the actual economic activity. So the way it's going to work going forward, really, for companies is that typically there will then be, for the first pillar approach, it would be that we're looking at 10% profits for certain multinationals. If they have as much as 10% profits, anything above the 10%, 25% of that will then be reallocated to the jurisdiction where the profits came from, right? And then that's the market jurisdiction. So you look at the likes of Facebook, Amazon, for instance, that do not necessarily have a physical presence in Nigeria. Part of their profits should be reallocated to Nigeria if Nigeria signs into this tax deal. For the second part is also to say that if there is a rate that is lower than 15%, unfortunately, Nigeria's rate is 30%, corporate tax rate is 30%. So there is really no incentive at the moment to sign in because we have a rate that is low, that is higher than the 15%. More or less saying that if you have anything lower than 15%, you would have to have your tax revenue exported to the home countries as well. So that rate, that differential would be paid. For instance, a country that maybe has a rate of 12.5% would have the 2.5% out of the 15% reallocated to the home country to ensure that there is a fair portion of tax that is actually paid on the income end.
Well, it sounds kind of complicated to the very simple mind. So whose responsibility will it be to show that a company, especially those who don't have, brick and mortar in a certain country, who would pursue it to ensure that this profit was made from this country, so you have to give this percentage and all that? Because, when it comes to tax, calculating and tracing it could be complicated, especially in the digital economy.
Yeah, very correct. And let me quickly add that the whole idea is that these rules will then be domesticated in the countries. So there is a model that is being worked on by all the countries that have signed in. As we know, about 136 countries across the world have signed into the tax deal already. So there would then be like a template model rule that will be worked out. And the idea is that rules like the significant economic presence rule that is meant to deal with this issue in Nigeria, and maybe the digital services tax rule that they have in France, that they have in places like India, will then be jettisoned and then will then align with this new rule that will be in the law. So the idea will be that if you then have, there will be a global financial statement expectedly, and it will also segment the activities of the companies into the different jurisdictions where they earn the profits from. So in simple terms, it's a case of I have made 100 billion in the year USD, and then out of the 100 billion USD, I'm a country that have my own country as the United States of America, but I also have presence, though digitally, in Nigeria, in France. And so a portion of the 100 billion in terms of profits needs to be allocated to those market jurisdictions and will be taxed at the global minimum tax rate.
So some countries are reluctant to hike their tax rate, like Ireland. They don't want to. Aren't they standing? Aren't they losing? Why? What's the reason?
Okay, let me quickly also say that Ireland has now signed in. They were reluctant at the time. Same with Hungary, and the issue for them was that they were concerned about sovereignty. They were concerned about how they will be able to play with their own laws to ensure that they attract the right sort of investment. Same thing with Ireland. Ireland had a tax rate, a corporate tax rate of 12.5%. And what that meant was that if you are then raising the minimum tax rate to 15%, certain countries, certain companies who may have thought that the best place to plan their taxes and to have their location is Ireland for tax purposes will then not be encouraged to do that because there is still a 15%. So there will be other factors that would make them consider other jurisdictions beyond just the tax, right? But interestingly, they have now signed in. We are now left with countries like Sri Lanka, Nigeria, Kenya, and I think Pakistan that are yet to sign. So really, it looks like the force is going towards signing into the deal.
So Nigeria has a higher tax rate, which explains why the country does not want to sign. But is that how it's just going to be? Isn't it going to mess up the system, the global tax, this agreement? Because then, some people can still say, oh, I want to go here, I want to go here.
Correct. And that's exactly the point here, because what you want to do with the global minimum tax and this sort of arrangement is to ensure that you ease trade tensions. And for instance, companies like Amazon, like Facebook, don't want to be faced with differing tax rules for their global operations, right? They want a unified rule, and that's why exactly the OECD has stepped in to do this. So with this, it could mean for Nigeria that we are toying with some sort of trade tension. However, I understand the position of the government that there is a need to also study the law, because what it means today is that if Nigeria signs in, it basically means that you jettison whatever rule that you currently have. And unfortunately, it is taking quite a time for the OECD to also come up with this final rule, right, that companies are signing into. So Nigeria could not wait any further. That's why Nigeria basically came up through the Finance Act, the significant economic presence rule. So as it stands, it means that if Nigeria signs in today, they jettison it, and then the global minimum tax rule will not be effective until 2023. So it may mean some sort of tax revenue loss to Nigeria as well. So it's a case of which way do we go first? Do we hold on to these and ensure that we don't have any trade tensions with any of those countries where most of these big multinationals, the 100 most profitable, are located, for instance?
So do you see Nigeria changing its stance, say maybe close to 2023, in 2023?
I see Nigeria aligning, if you have to look at it quickly. As I said earlier, out of about 140 countries, it's only about 4 that are yet to sign. And typically, when rules like these apply, there are benefits to it. And because there are benefits to the rule as well, like I mentioned, Nigeria has passed into law a significant economic presence rule. And what that helps to do is to pay, there is a share of the revenue of the profits of these companies, these multinationals, that should be taxed in Nigeria. However, I would say that not much of that has been achieved, which is why we also have the Twitter conversation also ongoing, right? So if not so much has been achieved, and you now have a platform where you can achieve a bit more in terms of the allocation of about $150 million to these developing countries that can then result in taxes for them, more taxes for them, I think it's just the way to go. However, it may not give a full benefit, right? Which is the concern about sovereignty, that, oh, if I am able to do that directly, I might be able to get more tax than the 15% tax that the OECD says I should collect. But what is the framework that you have to even collect the 30%? We don't have that fine-tuned yet. So it makes it difficult to also say, I want to stand alone. I don't want to work with other countries in the globe. Yeah,
because I was going to ask, I mean, even for our local normal taxes, we talk about the mechanism to collect it. We talk about, you know, the system, you know, strong enough to handle it. And now we have a system that should help us. But, I mean, like you noted, you can't just rush into it. But also, I guess it will also be important for the country to think about the mechanism to collect this tax and not just about having the figures on paper.
You're very correct, absolutely correct. So it's going to be a case of, like I mentioned earlier, we then have a global rule. And typically multinationals want to align with the laws because their own countries are also concerned about their global presence and their global corporate responsibility index. So if they already align into this and then Nigeria aligns into this as well, it would mean that at least there will be a fair share of tax from, you may say maybe the fair share is in inverted parentheses, for instance, because you then have the issue of, is it really fair, right? There are concerns also about, the 60% of the global profit will still go to the developed countries where these countries are residents, whereas it's only about 40% that is going down to the developing countries where the activities are really taking place. But again, like we said, the mechanism has to be in place, and this is a way to begin the negotiation. I think to be on the negotiation table, you also have to sign into the law first and then let it work for you. And then you can begin to say, oh, should we revise the minimum tax rate? Should we adjust the rules so that it's more reflective of the activities of these multinationals?
All right. Thank you so much for sharing your views with us. Temitope Kolade, Senior Manager at Anderson, talking on the Global Minimum Tax Agreement. Enjoy the rest of your day.
Thank you very much. Thank you very much.
So we'll just lean over to the markets now. Now here is Willie Bong to give us a review of last week's trading. Hello, Will.
Good morning, Ini.
Good morning.
I'll just start with some good news, especially good news that has been trending for some time. That Nigeria's forex reserves sustained its weekly increase, as the gross reserve position closed higher by $1.03 billion week on week to $39.42 billion. That's as of October the 13th. Now, at the forex market, we see that the total turnover of transactions for the week ended October the 15th stood at about $1.57 billion. And this represents an increase of 57.47%, and that's from $996.4 million that was traded in the previous weeks. And we'll move over to the investors and exporters window, which is the FX spot market. So that's the total value of transactions rose by 10.6% to $749.39 million. However, at the NAFEX window, the Naira fell by 0.1% against the dollar to 413 Naira 37 kobo, as against 412 Naira 98 kobo, that's an error there, in the previous trading week. Now, at the fixed income market, the bond market closed with mixed sentiments, although it was a bit bullish, as investors remain on the sidelines awaiting further clarity on the direction of yields and refocusing their attention on corporate instruments. The average yield paired by 1 basis point to 11.3%. Now we'll move quickly over to the equities market, where the market closed really bullish. The all-share index was up by 1.39% week on week. Was moved to 441,438.15 points, and the equity cap stood at 121.625 trillion naira. Well, we see that the volume also rose significantly. Value was at 31.65 billion naira, and the deals was 23,355 deals there. The Nigerian Exchange, another good news that happened there, the Nigerian Exchange Group listed about 1.9 billion naira worth of shares by introduction on the main floor of the NGX, and that has totally changed a lot of things. Now, to give us more insight about what's going on there, we're going to talk to David Adonri. He's a stockbroker at High Cap Securities Limited. Good morning, David.
Thank you. Good morning. Always happy to be with you.
It's happy to have you too. The Nigerian Exchange Group listed, well, like I mentioned, just with as I mentioned, 1.9 billion shares by introduction on the NGX platform. What changes should we expect in the equities market?
Okay, that listing was symbolic with the exchange itself listing its holding company. And before that listing, after the demutualization of the Nigerian Stock Exchange and it became NGX, the shares had actually been trading on the OTC NASD platform. But trading on OTC platform is a different ball game when compared to being listed on a regular exchange. And because NGX Group has successfully scaled the very stringent listing requirements, and is also going to abide by the post-listing requirements of such a regular exchange. It means, therefore, that the level of transparency will be very high. The corporate governance would also increase, since the public will now be actively involved in controlling that security. So it's going to increase investors' confidence in it. And then it has also deepened the capital market. It's a good development because the market has been firing on all cylinders, starting from last week, when for the previous week, when for the consecutive 5 trading days the market gained, and then last week the market also gained for some weeks, and the positive growth of the index has been sustained last week. There are also indications.
David, just bouncing off what you just said, you just mentioned that the equities market traded for the 5th straight consecutive day last week. But we also see that the equities market has maintained its bull run for the 5th consecutive trading week. Is this what we should be expecting going forward?
Yes, it is still likely that the market will be upbeat, although the rise may not be as a meteoric, the way we have seen in the recent past, because the market usually reacts to price-sensitive events occurring. You know, in the past few weeks, we have actually seen the crude oil market trending up, and the market usually moves in tandem with the direction of the crude oil. And other factors too have enabled the equities market to gather momentum. For instance, the macroeconomic condition has improved with inflation rate declining, GDP rate growing. So those are strong factors that are impacting positively on the market. But now that we are expecting the release of third quarter figures, it's also likely that the expectations will sustain the momentum in the market. So the equities market is actually out for a good run. But still that there might be a little slowdown perhaps today or tomorrow when the federal government issues some bonds. So that may reduce macroeconomic liquidity and prevent the inflow of massive assets into equities, since more assets will be flowing into the debt sector.
Thank you so much, David Adori, for your input on the program. That's David Adori, stockbroker. Thank you so much at High Cap Securities Limited. Now we see that the listing of the NGX from the NESD OTC platform actually made a big hit on that market, because the market lost about 24.29 billion naira. It was shaved off this market capitalization, although the market closed on a positive note this week, thankfully. So we'll still have a good one, both for the NESD market and the equities market. And we see that the market in the fixed income market closed bullish as well. Both are doing fine for this week, and we hope that, like you said, the earnings, the bond auction will determine if the direction of yield, basically.
Yeah, but we remember that the earnings in the last quarter did not have so much impact on the market. So we'll have to watch closely to see if this quarter's earnings will have much impact on the market anyway. Thank you so much, Will, and enjoy the rest of your day.
You too.
So we'll take another break now. When we come back, we'll do an opening call to London to stay with us. Yeah, welcome back. Head straight to London now with Juliana. Hello, Juliana. Good morning. Okay, so 500 jobs and a boost to the electric vehicles industry, and it's thanks to a new investment coming from Ford. Juliana, what's the details of this?
Yeah, this is, as you said, it's a massive boost to the UK's car manufacturing transition from petrol and diesel into electric. And it's reaffirmed Ford's commitment to the United Kingdom. Halewood, a factory in Merseyside, has won this £200 million bid to produce electric power units from 2024. It could have gone to Germany, so the fact that it's gone to UK is massive, possibly helped by a government scheme. The Prime Minister Boris Johnson put a pot of cash worth £500 million away as part of this green energy transition, and said that they would help firms with some grants, and I believe Ford will be receiving £25 million. So this is great news, and of course it's part of a wider scheme where by 2050 the sale of new petrol and diesel vehicles will be banned here in Britain. So there are several of these car manufacturers that are coming up with renewed projects to try and get electric vehicle making in this country at grand scale. Earlier this year, Nissan, I believe, they announced a £1 billion injection. So it's all part of that, and this is great news for the government. And of course, those 500 people in Merseyside who have managed to secure their jobs.
Yeah, well, good to start the week on a good note. And we also have Tesco beginning a program to buy back shares with a value of up to £500 million. What are they trying to achieve here?
Well, we're not sure. Firms do buy back shares lots of time. Tesco, Britain's biggest retailer, have announced that they'll be doing this using Citibank as a kind of intermediary, third party, if you like. They'll be buying them back on behalf of Tesco. This comes really after last week. They announced a bonza 6 months. They've done really, really well, which is great for them, because some supermarkets have been struggling because, of course, now that lockdown has been lifted and restrictions have been eased, people's shopping habits have changed. People going out more at restaurants because they're probably sick of cooking at home. I know I'm certainly one of them. So Tesco have had really great sales. And then, of course, we know that there's been lots of US private equity interest in Britain. First was the takeover from Asda, then there was that long duel of trying to win Morrison's, and there are some suggestions that Tesco could be next. So perhaps, and of course this is all speculation, they're buying back their shares to make sure they've got a large chunk. So if any private equity firm does want to try and buy Tesco, it's going to cost them a lot more money than it was to buy Asda and Morrison's.
Yeah, there's always a motivation behind it, Juliana. Well, thank you so much for that. I will talk to you later on at 1:30 during Business Incorporated.
Thank you.
So let's take a peep into the crypto market. This morning, the global market cap opened the week with almost a 1% increase. It stood at $2.50 trillion. Market volume over the last 24 hours was at 90.07 billion this morning, indicating a 2.78 increase. The total volume in DeFi currently $11.68 billion. That's 12.96%. Of the total crypto market 24-hour volume. The volume of all stable coins is now $70.65 billion, which is 78.44% of the total market in 24-hour volume. And, well, still having this serious bullish run is Bitcoin. This morning, it was $62,354. Continuing the positive trend, it added 2.74%, so 2.79%, beg your pardon, in 24 hours. And its dominance was about 47%. Its 24-hour volume was $31.65 billion. The gainers table, more of stable coins, except for Polkadot, which added 0.6%. Though most of the alts have moved to the red table. We have more of the stable coins now. Of course, on the red table, we have Cardano, XRP, Solana. Well, this is where the altcoins are residing for now, unfortunately. We have Lumiday additional to tell us what's going on in the market. Hello, Lumiday. I know you're happy. Bitcoin is over 62,000 at least this morning. I don't know what it is at this time.
Yeah, good morning. It's a bit exciting, knowing the fact that we saw some drawdowns on Sunday where Bitcoin fell below $60,000 mark, but it took a couple of minutes for it to spring back up 60,000. And the macros suggest that the rally might continue. You need to understand that there are about 7 metrics that is making Bitcoin being excited. First of all, Bitcoin investors are refusing to sell. Data from CryptoQuant shows that the number of Bitcoin on crypto exchanges are record low. That suggests that there are fewer investors that want to sell these assets. Secondly, the most important thing that you need to understand is that Bitcoin ETFs are coming on approval, meaning that by this week we see some ETFs that have Bitcoin fundamentals being in the United States security market, and that's a very big upside because that will also attract traditional investors. So we are seeing that that is also increasing the momentum. Also, we need to understand that inflation is at record high across different markets from England, Nigeria, and United States. So a lot of people are seeing the quantitative easing as another way to hedge against inflation, and that's why we are seeing Bitcoin still gaining momentum, despite the fact we are seeing other crypto assets dropping, and that's the decoupling effect of institutional investors on just Bitcoin. Also, you need to understand that the volume of trading in Bitcoin has reduced, telling you also that there is a lower amount of retail investors, giving Bitcoin more options to mature. So the price volatility you see in the past couple of months have reduced significantly. Also, you need to understand that Bitcoin miners are earning more, and that's why we see the difficulty or the hash rate in the record high. So that is also increasing the network efficiency and boosting activity around the blockchain. So the metrics are so exciting right now, but you see, we need to understand that we are in Q4 and the US Fed, I'm talking about the US Central Bank, is talking about increasing the economy, meaning that at some point it has to tighten the liquidity. So the dollar is also gaining momentum. So we expect that at one point the dollar might come Bitcoin's price, but time will tell, you know.
So we see the altcoins in the red. Obviously, Bitcoin is, once they always go on, not always, but most of the time, they're on opposite direction.
Yeah, actually, what usually happens is that usually Bitcoin usually leads market, and being the fact that Bitcoin happens to the market value of Bitcoin happens to take almost half of the crypto market value. So the sentiment around Bitcoin also seems to go around other altcoins. But the narrative is changing because we need to understand that institutional investors are keying more on the flagship crypto asset. And that's the credence that you look at the likes of Tesla, look at the likes of BlackRock, the biggest asset manager, look at the likes of JP Morgan, the world's most valuable bank. They are directly getting exposed to Bitcoin rather than other assets. So I think it will take a matter of time for us to see other assets gaining momentum. But right now, I think Bitcoin is the star in the block.
So what would be the smart thing to do now as an investor in this scenario?
Yeah, the smart thing to do right now is that for those that have invested, especially those that invested at the tip, well, they have nothing to lose to reduce their exposure or keep the pool running. For those that have not invested, I advise you need to be very cautious because right now, Bitcoin is less than 4% to its record high. So investing right now, you are likely to get exposed to drawdowns, and drawdowns could come in anytime from now. So I think for people that are just new to the market, this is the time for you to start understanding how Bitcoin works and stuff like that. And also, you can also benefit from other crypto assets because while Bitcoin is hitting other records, is about hitting record high, you see other altcoins just coming up. So I think investors need to be very careful and not to get exposed because, like we said, they're expecting the economy to taper very soon with rising inflation. So global central banks at one point will tighten liquidity. So it's word of wisdom for investors not to get too exposed.
Back this week?
My estimate for Bitcoin, well, I think based on the fundamentals, I think the momentum will still be with Bitcoin. But you see, the rising dollar and US 10-year Treasury yield is a form of concern. So I see pullback. At some point. But the narrative is that I don't see Bitcoin dropping below $50,000 this week.
All right. Thank you so much, Lumiday, additional investment and financial market analyst, for sharing your thoughts with us. So that's it on the program today, the first one for the week. 4 more to go, so do stay with us. But do remember at 1:30, Business Incorporated will be here again with updates from the world of business. I'm Ini John Mekwa.